How to trade bull flag and bear flag patterns effectively. What are bull flag and bear flag patterns? Bull flag and bear flag patterns are continuation patterns in technical analysis that signal a temporary pause in a strong trend before resuming. A bull flag forms during an uptrend, characterized by a sharp upward move, the flagpole, followed by a slight downward or sideways consolidation, the flag. Conversely, a bear flag appears in a downtrend, with a steep decline, flagpole, followed by a minor upward or sideways correction, flag. These patterns are highly reliable because they reflect natural market psychology, profit-taking after a strong move, followed by renewed momentum. The key to identifying these patterns lies in their structure. The flagpole should be steep and show strong volume, confirming the initial trend. The flag portion should have weaker volume and shallow retracements, typically no more than 50% of the flagpole's length. Flags often resemble small rectangles or pennants, sloping against the prevailing trend. Recognizing these patterns early allows traders to capitalize on the continuation of the trend with favorable risk-reward ratios. How bull flag and bear flag patterns work. The mechanics of flag patterns are rooted in supply and demand dynamics. In a bull flag, the initial surge, flagpole, represents strong buying pressure. The subsequent consolidation, flag, occurs as short-term traders take profits, but the underlying demand remains intact. Once the selling pressure subsides, buyers re-enter, pushing the price higher. The breakout above the flag's upper boundary confirms the continuation of the uptrend. Volume plays a critical role. Ideally, it should diminish during the flag formation and spike on the breakout. For bear flags, the flagpole reflects aggressive selling, often driven by panic or negative news. The flag forms as some buyers attempt to bargain hunt, but the overall sentiment remains bearish. The breakdown below the flag's lower boundary signals resumption of the downtrend. Like bull flags, volume should decline during the flag and increase on the breakdown. Traders often measure the projected move by the length of the flagpole, adding it to the breakout point for bull flags or subtracting it for bear flags. Practical example, trading a bull flag in Tesla. Let's examine Tesla in early 2025. The stock surged from $220 to $360 in 3 weeks, flagpole. It then consolidated between a congestion range for 2 months, flag, with volume dropping by 30%. The breakout occurred at $350 on above-average volume, signaling a continuation. Using the flagpole's length, $140, the projected target was $480, $340 plus $140. Tesla reached $470 within 3 weeks, validating the pattern. This example highlights the importance of volume confirmation and measured moves. Traders could enter on the breakout with a stop loss below the flag's low. SEPT Investing's AI-powered stock reports could have identified this setup early by analyzing volume trends and institutional flow, giving traders an edge. The platform's real-time signals also alert users to potential breakouts, ensuring timely execution. Common mistakes and what to watch for. One frequent error is misidentifying flags. A bull flag must form after a clear uptrend, not during a range-bound market. Similarly, a bear flag requires a preceding downtrend. Another pitfall is ignoring volume. Weak volume during the flag or no volume spike on the breakout increases the risk of a false signal. Traders should also avoid overly aggressive position sizing. Flags can fail, especially in volatile markets. Timing is another challenge. Flags typically resolve within 1 to 3 weeks. Prolonged consolidation may indicate a reversal instead of a continuation. Using SEPT's smart money tracking can help distinguish between genuine flags and potential reversals by revealing whether institutions are accumulating or distributing during the consolidation phase. Always combine flag patterns with other technical tools, such as moving averages or RSI, for higher probability trades.